This is not financial advice, educational content only. For decades, a company could lease millions of square feet of retail space, hundreds of aircraft, thousands of pieces of equipment, and none of it appeared on the balance sheet. The obligation was in the footnotes. Disciplined analysts added it back manually. Most automated screens ignored it entirely. For fiscal years beginning after December 15, 2018, that changed. FASB's ASC 842, introduced through Accounting Standards Update 2016-02, moved operating leases from footnote tables onto the face of the balance sheet as right-of-use assets and operating lease liabilities. Today, what the rule actually changed, what still hides in the footnotes, and what you should pull before trusting the reported number. Let's look at what the filings say. When ASC 842 hit annual filings starting in fiscal 2019, the business press reported companies adding billions to their balance sheets overnight. That was accurate, but the framing was misleading. The obligation wasn't new, it had always existed. What changed was visibility. Under the prior standard, ASC 840, operating leases lived in footnotes as future minimum rent commitment tables, undiscounted, unweighted, sitting quietly in the notes. Disciplined analysts were already capitalizing those commitments manually. What ASC 842 did was standardize that work and force it onto the face of the balance sheet, where it feeds into reported leverage ratios, debt covenant calculations, and any automated screen that never reads footnotes. That's a meaningful practical difference, even though the underlying cash economics of those leases didn't change. That's my read. The mechanics, the lease liability, is measured as the present value of remaining fixed lease payments, discounted at either the rate implicit in the lease, rarely determinable, or the company's incremental borrowing rate, the rate they'd expect to pay to borrow a similar amount on a secured basis over a similar term. The right-of-use asset starts at the same value, adjusted for prepaid rent and lease incentives. For operating leases, the income statement treatment is largely unchanged, one straight line lease expense line. Finance leases, the old capital leases, still split into ROU asset amortization plus interest, front-loading cost. That distinction matters when comparing two companies with similar fixed obligations structured differently. Their free cash flow numbers will look different even on identical economics. On the cash flow statement, operating lease payments stay in operating activities. Finance lease principal goes to financing. For a mixed portfolio, real estate on operating leases, equipment on finance leases, you need both footnotes before you have the full picture. The balance sheet number is a summary. 3 things in the footnote can move it materially. First, the discount rate. The footnote discloses weighted average rates for operating and finance leases separately. Two companies with identical lease cash flows can show different balance sheet liabilities if one used a lower incremental borrowing rate at inception. A company with strong credit arguing a low rate will show a smaller liability for the same payment stream. Check the rate against the company's credit profile during the period leases were signed. Second, renewal option assumptions. If a company judged at lease inception that renewal was reasonably certain, those renewal periods are included in the lease term and the liability is larger. If they excluded renewals, perhaps arguing genuine optionality, the balance sheet understates the real long-dated obligation. The footnote should state whether renewal options were factored in. Third, what's excluded entirely. Leases with original terms of 12 months or less qualify for the short-term exemption and stay off balance sheet. Variable lease components, percentage rent tied to sales, for example, are expensed as incurred and excluded from the liability calculation. For a retailer with significant percentage rent clauses, the balance sheet figure captures only the fixed portion of the real estate commitment. That's my read. The practical tool next time you're in a 10K for any lease-heavy business, retail, restaurants, airlines, pull 3 numbers from the lease footnote: weighted average remaining lease term, weighted average discount rate, and the undiscounted total from the maturity table. Compare that undiscounted sum to the discounted liability on the balance sheet. The gap tells you something about both the duration of the obligation and the rate assumption embedded in the number, wide gap long duration, or a suspiciously low discount rate. Any of those warrant a closer read of the footnote. This isn't advice, it's a way of looking. I'm Diane, back next briefing.